Hello and welcome everybody to the Multifamily and More Virtual Mastermind. I am your host, Jamie Gruber, along with my co-host, Benoit Malige. Say hi, Ben.
Hey, Jamie. Hey, David.
What's up, guys?
Ben is, every month I say, he's a man of few words. When he speaks, though, he speaks to kill. So just know that. He barely ever talks, but when he does, he's ready to roll. Fun night tonight. I'm going to get to our guest here in just a moment and talk about what he will be doing tonight. But before that, I just wanted to make a couple of quick points. One is David's going to go through a lot of really cool stuff tonight analytically, right? He's going to go through how to break a deal down. And there's a lot of interest from a lot of people in learning that, not only just doing a deal, but all the little nuances of it. You don't learn just by listening. You learn by reflecting, right? And I know some people are out there kind of like, hey, I don't want to be seen or heard. I understand that. But I would just encourage you to, in the chat box, as we're going along, as David's putting some stuff out there, just drop in what you took from that, because it not only helps you remember and recall, but it also helps others kind of, see the point made, and maybe helps them to remember and recall later when they're doing a deal analysis. So would love to see you guys, as David's going along, talk about what you're hearing from him. And in fact, right now, I wouldn't mind seeing you guys put in what you hope to see. What are you looking to get out of tonight? That would be great. To drop in the chat box to everyone, change it to everyone, not just to panelists. So this way we can get a sense of, what the temperature of the folks out there is. But our goal is for you to learn. That's it, for you to learn. So make sure you're putting out what you hear from David so you can reflect back and make sure you're learning that. The other part of that is we put a ton of content out on our YouTube channel. And I would encourage you to go over there if you're looking for this video eventually to reflect back on, or other videos that we've done with similar lessons, to go to youtube.com/multifamilyandmore and put it in there and subscribe for yourselves so that you can get more and more content coming to you to learn and grow and do all the things you're trying to do in this space. So those are my two things I'd like to see. I want to see everybody take something away tonight. And I think those are two ways that you can absolutely do that. Okay. A copy of his analyzer. There you go, Mike. Yeah, we're going to talk a little bit about that as we go. So let me introduce our esteemed guest. So David Toupin is a top millennial real estate investor, speaker, and entrepreneur. He's the co-founder of Obsidian Capital. He started investing at 20 in Michigan, where he bought his first property in college, a 12-unit apartment complex, which, by the way, is almost the exact same complex that Ben and I bought the first time.
Really?
2 blocks apart, 2 different buildings, the whole thing. What city? Pinckney, in Pinckney.
Okay. Yeah, I remember Garden City. So.
Yeah, it's 16 units,
cool.
But it's a very similar story from what I've heard. David has built a real estate company as a key principal with over $50 million in real estate, all by the tender age of 24 years old. Guy's amazing. He's also the creator of the best-selling multifamily deal analyzer, which is now being converted into a web-based software platform called Real Estate Lab. And David will talk more about that as we go along. So welcome, David. Glad to have you.
Thank you, my man. I appreciate it. Thanks for having me.
Very, very glad to have you on the show. I love the intro, Jamie. Thank you very much. I guess we can start right from there. You're 24. You've accomplished a lot at such a young age, David. So why don't you tell the listeners, for those who maybe don't know you that much, what you did to get to this point in your investing career?
Yeah, thanks, man. Gosh, I think a big part of it for me was just laser focus. A lot of people really want to get involved, get in the business, buy apartments, and they get caught up in a lot of the stuff that really doesn't matter. And what I found helped me grow, and what has not only helped me buy apartment complexes, but has helped me bring enough value to partner up with my current business partner, who has owned almost a $300 million portfolio of apartments. And we started a company together. Now, how does a 24-year-old kid halfway across the country get in a position to do that? Really, he found value in the analytical side of me, and the fact that I was really good at running numbers and understanding the financials so that we are buying properties correctly and that we go in and are able to hit our projections. And that's such a huge part of this business. Anyone that wants to get involved, you either have to know the numbers and know how to do what I'm going to show you guys in a little bit here, or you have to at least be able to understand it and read it and maybe have a business partner or hire someone that can do it. So it's so essential that you know the numbers. This is such a numbers-based business. It's not a fun thing for a lot of people. I'm so happy right now because I love doing this. I'm excited to show you guys this. A lot of people will probably fall asleep during this video. It's okay. I'll try and keep it interesting. I'll try not to get too nitty-gritty. I get that it can get a little bit boring, but for the people that are on here, hopefully it is something you're really interested in, and I could bring a lot of value to you guys. Another thing I will say is I started small, as he mentioned, a 12 unit, relative, but it's small in terms of apartments. I suggest a lot of people do the same thing. My advice is contrary to a lot of the gurus today that want you to go and buy a 100-unit apartment complex. I think that's dumb to do on your first deal. You're only going to lock yourself into a corner and really be handheld by someone who actually knows how to do it. And the best way to really get it, unless you find a great deal, right? If you find a great deal that's over 100 units, bring it to the table and partner with somebody that has the ability to do it, that's fantastic. But if you really want to get in and learn the nitty-gritty, start a little smaller, be hands-on, raise capital, learn the whole process. Self-manage. I self-manage my first 3 properties. The one I'm going to underwrite with you guys today, 96 units, I house hacked it. I bought it. I moved in. I put $0 into this deal. I raised $1.7 million, bought it, held it for a year and a half. I almost doubled investors' money in under 2 years selling this. And I lived in it and self-managed it. And so gotten a ton of learning experience through that. I GC'd the whole renovation. I mean, I'll get into it with you guys, but with $0 into that deal, I made several $100,000 on the exit from my sweat equity in the project. So that only goes to show how powerful the syndication business is. Not only is it fun, you can make a lot of money, and anyone can do it. Doesn't matter how old you are.
So,
right?
Yeah. So two quick follow-up questions. If you're not a numbers guy like you are, what do you do? And number 2, if you could just explain how is it that you've grown so quickly in such a short period of time? Is it because of the right partners, or is it if you could just?
Yeah, I mean, I've had good partners, bad partners. I think definitely having good partners helps. I think honestly the biggest thing is I work a lot. There's a famous video out there that Elon Musk says if you take somebody that's working 50 hours a week and put them up against a man that's working 100 hours a week over the course of a year, the person that works 100 hours a week is going to get twice as much done. And that's simply what I think has happened with me. I work a ton. I put a lot of effort into it. I've really put a significant amount of time and practice into mastering this business. And so, from very early on, I cut my learning curve down by so much because, not only did I watch and learn from a couple people underwriting deals, but then I went and did it, and I underwrote hundreds and hundreds and hundreds of deals, regardless of whether they were going to work or not. I still put the time in to underwrite it, play around with the model, and that's how I wound up with this financial model that I now have sold to hundreds and thousands of people use the free version. It's wildly beyond what I ever thought it would pull up to, but that just came from the practice and putting the time in.
That's that's your competitive, as I know what's in people's minds that are my age, right? I'm married, I got kids, I got this, it's like, but if you're married, kids, this, that, and the other, you might have some money, or you might have, a bigger network. When you're 20, you have time, right? That's what you have. And you leveraged your competitive advantage. That's what's impressive, because, it's almost implying by saying, well, I don't have that kind of time, that every 20-year-old puts in that kind of time, and they don't. You're unique because you took the one thing that you could leverage, and you went all the way in on it. And that's the difference. Everybody has something that they can utilize. Everybody has a superpower or a place in life or something that they can leverage to get themselves there. It's tapping into it. And that's what's so inspiring about your story is no excuses. You just tapped into, okay, what do I have? I can work 100 hours a week doing this. I'm a young guy. I'm unattached, all that stuff. I'm gonna leverage that. So plenty of people can do the same thing in a different way. It's just a matter of being creative.
Yeah, and I'll give you another story to counter that, right? I mean, I'm young. You come out of, I started in college. I was broke. I think I had $5,000 in my bank account when I really jumped full-time into real estate. So I really didn't start. I started with nothing. my business partner, Glenn, had worked his way up in the corporate field. And a lot of people maybe listening to this might know Glenn. He just released a book called Maintenance Man, a Millionaire. He started as a maintenance man in his 20s on apartment complexes. And he worked his way up the ladder to leasing agent, property manager, regional president of the management company. He didn't buy an apartment complex until 7-8 years ago. And he started buying, working full-time job. Then he started buying. And then his wife went to the hospital for a double lung transplant. And for over the course of that entire year, which is a serious, I mean, that's almost like getting brain surgery. It's a huge deal. And during the course of while she was having that all done, I think by the time she was out of the hospital and really cognitive, he had bought over $100 million in property. He was holding her hand while she was awake. And then when she was asleep or under surgery or, not with it, he was putting together deals. So there's no excuse for not being able to do it. I just think it's how aggressive are you going to be? Are you going to be tenacious? And are you gonna go after it and just take it? Right? It's not gonna happen. No. If you just sit there. You got to take it.
Agreed completely. I love it, and you're getting a ton of love here in the chat on the live stream as well. Lots of people are saying hi. They love what you're doing. You're inspiring and all of that. So you've got obviously a great following, and that's why we wanted to have you on tonight. Let me ask you this before we dive into the analysis piece. So Dave's going to share a screen here in a sec, guys, and we'll get to the meat of why we're here. But I think this is relevant, and that is in the current time that we're in. As we're recording this, if you're watching the replay, we're in the middle of this whole coronavirus, COVID-19 craziness, right?
Yeah.
And there's a lot of speculation. In fact, there was a conversation in one of the groups today around, what happens in the next 3 months or 6 months with multifamily, and no one has a crystal ball. But if it is at all, how has this pandemic and the impact it's had so far and what you anticipate the impact will be, how has it had an impact on how you're analyzing property, how you're looking for property, what you're considering as far as the next property you may want to acquire? Is there a timing? Just kind of COVID-19 coronavirus, what is that doing to you right now in your business?
Yeah, so really interesting question. I think it's probably good timing that we're having this now because there are a lot of changes going on. Some good, some bad, and I definitely want to break that down for you. I've been staying really on top of the financing side of things with my loan brokers and communicating with Fannie Mae, Freddie Mac, just figuring out what is going on there, what are the changes. So I definitely want to share that all with you especially as we get into the financing portion of this call. In terms of an impact on our business, it's really interesting because we went under contract on 230 apartments about a week before coronavirus hit. And the week that everything started going crazy, I was actually up in Michigan doing my in-unit inspections. And I believe it was on a Wednesday, we toured apartments and we got through maybe 75% of the units. Literally to the next day, I mean, things felt like they changed overnight. We only got in 25% of the units because people weren't letting us in. They're like, what are you doing touring units with coronavirus? And we're like, hey, we get it. If you don't want us coming in, we won't come in. But I knew it was only going to get worse and we had to get through. So, we had that deal. And then I just went under contract on 170 apartments in Fort Worth just a week ago. So we're still buying, but that deal came actually back around. We've been working on it for several months because of coronavirus and because the seller is making, in my opinion, a more emotional decision. They want to, they want to sell it and they don't want to be too impacted by all this. So, they felt it was a good time to sell, and we felt it's still a great deal. So we're still buying, but we're very cognizant of the changes in financing. A lot of banks have pulled out. I think a lot of regional banks, bridge lenders, they have all almost shut their doors saying like, hey, we're just taking a couple weeks off and seeing how things go. Too much uncertainty. Insurance lenders, CMBS, same thing. They're pulling out. Really the only lenders I see that have stayed solid have been agency, which is great for us as multifamily lenders, Fannie Mae, Freddie Mac, and HUD. HUD was a lender. HUD was the most consistent lender through the last 20 years, right? Through the last recession, HUD lent the entire way. If you had a project that met, HUD will lend. Fannie and Freddie pull back a little bit, but they're still there. And what they're doing now is implementing, and this changes week by week, but as of right now, the most current information I have is on a deal by deal basis, they're going to make people escrow, up to 12 months of principal and interest payments up front, which will then cover payments for the first year. And then also, an additional year of taxes or insurance. So these are all things that we've got to take into account when we're underwriting. Is we've got to bring more cash up front to buy the deal.
Sure.
But then we can feel really good that taxes, insurance, and mortgage payments covered over the course of the first year, right? So it balances itself out, but it definitely changes the underwriting. And I think.
Go
ahead.
Yeah, no, on that, definitely makes sense. And it's amazing how quickly you're shifting. And then just real quick again, before we jump in, how about on your current portfolio? Like, have you cut off distributions to investors? Like, I'm just kind of curious, what has it changed with the stuff that you already had under management, the stuff that you already owned, if anything?
Yeah, so because this happened right before Q2, we do quarterly distributions. This happened a couple weeks before Q2. We did send out an update saying we're going to halt all distributions to investors for the time being until we have more knowledge on what's going on. Fortunately, every property I own, I feel really good about. We bought at the right price. We have huge reserves on all of them. We can go months practically without any income and we'd be fine. So, I feel good about that. In terms of collections, I think a lot of people have actually had pretty positive collections in this month so far, where everyone was kind of worried. We're up to about, on average, 80 to 90% collections so far, which is fantastic. I mean,
Sure.
It's no different than any other month. So May is I think it's going to get interesting come May.
Agreed.
So we'll
I think, the stimulus and all of that, who knows what that'll do,
Sure.
but there's an impact. But to your point, everybody was kind of thinking 50 to
Slightly
60% collection in April, but we're at 100% in
great,
April
yeah.
for our small portfolio.
Yeah.
So yeah.
Yeah.
Cool. We've got a bunch of questions popping in. We're going to try to get to these guys. I see them. I see a Q&A. There's all this stuff, but let's get into the heavy stuff. Let's get into the deal that you brought to the table. You said a 96 unit. So whenever you're ready, feel free to share, and I'm going to let you take it away, guys. I'll jump in as questions come in. So if David's saying something, I'm going to monitor the chat box so he can focus on the analysis. And we talked before. Let me jump in on this, David, real quick. Here's a question. So I'll interrupt. I'll do what I have to make sure this stuff gets answered. So make sure you're active in that box. And again, reflect what you're learning. Make sure, that's interesting. Didn't realize that. That's it. Just repeat what he's saying if it's something that you just learned or that you just took away. I think it's important for you to retain that information that way. So, David, without further ado, it's all you.
Love it, man. Well, it looks like we got about 90 people on here, which is awesome. Yeah. I'm going to spit my gum out here so we can talk a little bit better during this whole thing. Really excited to share this with you guys. This, what I'm going to be analyzing today, I want to walk you through actually step by step in the underwriting tool that I've created. It's a deal analyzer. It's available on my website, and I'll drop the link later on there. But it's a 96 unit. It is located in Southfield, Michigan. It was a C-class property that we took to up to kind of a B minus status. It's located in a B minus area. And so it's kind of your classic value add. I bought it from the original owner. He had built it 40 years ago in 79. I bought it in 2017, and I sold it in mid-2019. We did fantastic on it. I bought it for $4.2 million. We sold it for almost $7 million. So a huge price increase in just a short amount of time. Part of that's due to demand in the market and decreasing cap rates, and part of that is due to the value add that we did, which I'll kind of go and show you. So really, to start high level though, why do we do this? Why do we run the numbers? There's a couple reasons. So first thing is we want to know what our returns are going to look like for how much money we're spending. We're going to spend X amount of money, and we're going to get X back from that. And so we want to accurately be able to depict and project that out. And then our goal is to go and buy the property and hit those numbers. So it kind of gives us like a plan of attack, right? Having an underwriting tool built out. Second thing is really, and the primary thing is to figure out what price to pay. Everybody wants to buy apartments, but really when you get an apartment deal sent to you, what's the next thing? You got to make an offer. If you want to buy it, you got to make an offer. So for you to know what to offer and to feel comfortable about that, you've got to feel comfortable with the numbers, and you've got to run them through some kind of a model to understand that you're paying the right price, that you're not overpaying, and that you're going to be protected. And so I'm going to kind of show you how we do that. Really, the gist of it is we grab two documents. I can do this with 2 documents. I've actually done it with none before. This property I bought with only a rent roll. He gave me 0 financial statement. You guys are gonna see one today that I have, but he gave me 0 financial statement when I purchased it. So I had to kind of come up with numbers on my own, and they ended up working out. But today we're gonna look at it with those financial statements. So the 2 statements you need are a rent roll and a T12, and I'll explain what both of those are. So the first thing is a rent roll, is pretty much just a list, and I'll show you guys right here. You get a little screen share going on. There we go. So the first thing is a rent roll, guys, and these come in all shapes and forms. This is a very standard rent roll, I would say. There's depending on the software you use, property management software, you're going to see a ton of different formats of these, but essentially they all look the same. You are going to have a list. You are going to have a unit number, occupant name, which I've blurred out for the purpose of this video. You're going to have monthly rent or lease rent. Sometimes also say market rent. So, you can compare what's the market rent versus what's actually on the lease. Square footage, they'll have lease starting date, expiration date. So, you could tell just right away when I look at a rent roll and I see, we bought this in 2017, 2008 move-in date, 2009, 93, 2011, 2002, 98, 07, 05, 01. Look at how long some of these tenants, 2001, like consistently, these tenants have been there for a long time. When I see that, I normally assume that they're going to be below market rents, and that, this owner is really just going for high occupancy and keeping the rents lower than what they really should be. A healthy property where you're having market rents, typically you're not going to see tenants that hang around that long. Sometimes you will, but that's just an example. So, and the security deposit would be the last thing that's typically going to be on a rent roll. Near the bottom, you should find some sort of summary. How many occupied, how many total units, how many vacant. So, we're 98% occupied when we bought it, and so that's a rent roll. And so that's important because we know what the current rents are, and then we can start figuring out where can we get the rents to. So that's step 1. Step 2, the second document you are going to want, let me see which is the right one here. I pulled up 2, so hopefully I've got the right one. You're going to need a T12. So that is what this document is. And a T12 is basically just a 12-month financial statement. So sometimes they call it a profit loss or a P&L. They might call it a year-end financial statement. Depending on how sophisticated the owner is, a lot of times on smaller properties, you'll see just the maybe the annual. They might have all the categories and they just have an annual. So that would just be like an annual financial summary. But what we really want, if possible and if available, is a T12, which is a 12-month financial summary. It's going to give you the best picture and view of what's going on month by month in each category of the financials. And you get to really see how the property has operated over the course of the last 12 months. And sometimes we'll request back 2-3 years. So, but really, if you have the past 12 months up until the most recent month and a rent roll, you are 100% ready to dive in and start underwriting a deal. So I will get a little bit more into this and reading a T12 and what to look for in a couple minutes, but that's kind of the gist of these 2 documents. I think you guys can see this starts with income. Up at the top, we've got our income section, potential, we've got our vacancy losses, RUBS, like utility reimbursement income, other income and fees, and then it hits our total operating income. So, we look at stuff like trends. Is this trending up? Is it trending down? What are the last 3 months really, which is the most important? So, similar things we're going to look for here that I'll dive more into. So, do we have any questions, Jamie, up to this point? Anything?
Ben, if you can help me out, my chat box just flaked out on me for some reason. So anything that's jumping up.
Yeah, you have to open it.
There we go. Yeah. Tom
There's just a question about the T, what the T meant, if the T was trailing, and
trailing.
Trailing.
Yep, that's exactly what it means. Trailing 12 months. Yep. Yep. And Tom, I think we've met before. I hope you're doing well, man. It's been a while. I see a lot of familiar names. This is awesome. Mark, Paul Evans, that's great. So next thing you're going to need is some sort of financial model. Like I said, this is one that I've built from literal scratch. It started as nothing over the past 3-4 years, and I built it out into what it's at today. I really don't change it much now. I haven't made many changes over the past year just because it's got everything I need. I've bought, over $50 million of property using this. I'm under contract on 410 apartments right now that we're buying. I've underwritten all those deals using this. So it's a tool we use all the time in our business. I'm even taking it right now and spending quite a bit of money to turn it into an online web-based software. So it's going to have a bunch of new features, and I can talk about that a little bit more later. But really, you just need some sort of model, and there's a lot out there. You need some sort of model that helps you project and accurately depict what's going on here. So I'll give you guys a quick rundown of what each page does so that you kind of know the overall, and then we'll dive back into this first page and start getting to the good stuff. So really there's 6 tabs. Inputs sheet, it's pretty self-explanatory. If you guys can see here, you only edit the blue cells. So on this analyzer, there's cells that have this blue highlight. Those are cells that you can edit. You do not want to touch anything else because anything else would have an equation in it, and that would mess up the analyzer. So you just want to edit what's in the blue cells. You don't have to fill out something in every blue cell, but it just indicates that's an input. So most of the inputs I've consolidated to this first tab to make your life pretty easy. You spend a bunch of time inputting stuff here, and then you can start going and looking at the rest of it and seeing the data that comes out of it. So, up at the top, we've got a section to help you estimate future taxes. We've got a section to input operating expenses. We're going to take these numbers from the T12, which I'll show you guys in a little bit. These are future projections. We've got some growth metrics. And I'm going to speed through this because I'm going to come back around and go more in detail, but I'm just giving you an overview. Down here, we've got some, historical financial information we're going to input. Your unit mix. So, how many 1 beds, 2 beds, 3 beds do you have? What size and how many? These are your rents. So we've got a section for, a lot of times we go into apartment complexes and we plan on increasing the rents as is, and then we also make plans to renovate units and increase the rents. So we have a section for, hey, what are the units going to rent for if we don't renovate them, and then what are the units going to rent for if we do renovate? So that's that. We've got a bunch of, oh yeah, go ahead.
Sorry, no, but as you're going along, I'm sorry, my thing flaked out, but I got it back. But just a couple of quick questions that are popping in that preface before you go too far. And if you mentioned, I apologize, but there are 3-4 questions about finding the deal. Like, was this a broker or were you doing some marketing to find this deal? How did you actually come across this one?
So this one came from a mailer. I mailed the owner. Most of our deals do come from brokers, but this one we sent a piece of mail to the owner, and he was a local guy. A lot of you guys are from Michigan, the Townsend Hotel in Birmingham. He owns the Townsend Hotel downtown Birmingham. He owns $1 billion in real estate, and for whatever reason, he decided to pick up the phone and call me back when I sent him a mailer about this. This was his oldest and smallest property. So.
Got it. All right, so you do both brokers and mailers, but it sounds like brokers are your bread and butter.
Correct. Yeah, most deals come from brokers, but I mean, I can go a little bit more in depth in our acquisition system after if you'd like me to. But we cold call, we mail, we brokers, everything. Yeah.
Let's do it. And hey, while you're talking, I saw you dropped the price. Is there a website to get the analyzer just so people know where that is right now, real quick? I could type it in.
Yeah, I could. I can type it in right here. It's Obsidian Capital Co. .com/deal analyzer.
There you go.
That's right. Let me know if that works. If it doesn't work, shoot a comment in there. But yeah, you can copy and paste it right there. Perfect. There's a free version on there as well. So you guys go download the free version. It's free.
Got it. Okay.
Cool. So we've got some closing costs here. It's all pretty self-explanatory. And then down here we've got, because we syndicate deals and a lot of other people do, there are different scenarios we might want to have with preferred returns and different splits of the equity and whatnot, acquisition fees. So we've got all that. So that's the inputs page. That probably has 80% of the inputs in this whole thing on this one page. So you fill that out and you're almost there. Next page is the pro forma, which really is, I would say, probably the most important piece. This is what really all the data goes into and creates your year-by-year projections going forward. So I've zoomed out just to show you these categories, but we've got, just like the T12, we've got our income, operating expenses, get different categories here. This leads to your NOI, your net operating income, which is one of the most important numbers here. That's what determines the value of the property. And then we've got some financing expenses, so your debt service, principal, and interest. And then it leads to your net income, which is the final number, and this is the cash flow that you make at the end of the day. So pro forma, pretty self-explanatory. It's a 10-year setup. And then it compares your T12. What I like is you input all the T12 info, and then it lets you see side by side, what am I spending on one thing versus what I'm projecting going forward. So I think that's really important. Income and expenses. This page isn't super important, but it's got some analytics and some metrics. It kind of breaks down your new unit mix. And then it's got all of your out-of-pocket costs besides the down payment on the loan. It's got everything here besides that. So that's that page.
There was a quick question since we're on income and expenses. On expenses, right above, how do you account for the cost of building materials for renovation? So in a more general question, I guess, how do you account for renovation? Do you have some rule of thumbs? Do you do by the square footage of certain rooms, or does it vary by area? How do you do that?
Yeah, that's one thing that's really tough because it was something that I didn't have nailed down at first and really had to learn from doing a lot of projects, getting those numbers. But at first, what you can do is you can get with somebody, let's say, especially if you're using a property management company, a lot of times they'll have a renovation department. You can work with them, walk through the project with them and say, hey, can you help me come up with a budget? Or walk through with the general contractor and point out different items. I can tell you, I can ballpark pretty well nowadays certain items on properties, like what is it going to cost to repair, per balcony or paint buildings or replace a roof or a parking lot. I could estimate, but at the end of the day, we do get a contractor involved once we are either close to an offer or going under contract or under contract. Then we'll actually get a contractor to go out and bid everything. So at first, do your best to estimate through some studies online or talking to a contractor friend. But it is one of those things that really you won't know until you do a lot of it and see the costs themselves and are actively involved. So
makes sense.
Yep. So and then that leads perfectly into this page, the renovations page. Up at the top, it kind of summarizes everything. But down here we have a couple different sections. How I mentioned before on the inputs page, where you can have renovated and non-renovated rents. This is where you choose how many units you want to renovate. So we might have 48 one bedrooms and 48 two bedrooms. How many of those we want to renovate, and what's the cost per unit to renovate? And when you decide that how many of those you want to renovate, it actually pulls out down here. And so instead of now, the 48 one and two bedrooms at the regular rates, we now have 24. I did half and half, as you guys can see here, 24 of this, 24 of this. And these are our new rates, which we're hoping to get an increase because we're spending an extra $5,000 per unit. So I've seen people underwrite deals where, they put in a unit renovation cost, but they have all the units going at this new renovated rent when they only budgeted to renovate half the units. You've got to take into account that you've got half the units still achieving the old market rents and half the units that are going to be getting renovated rents. So that's a really important section to have. You've got a bunch of general items here that you can add. We did 3 roofs; they're about $22,000 a pop. We did some siding, 6 buildings, 25. So these are just a tool to help you add up and label out everything that you want to do. So that's what these boxes are for. Financing details. This page is really important because this is where you choose your purchase price, which is normally one of the last things that I look at once I input everything else. I'll normally start by putting the asking price in there, which we can do today. I think they might have been asking like 5.2 or something like that. So I'll just put that in there. And then you choose your acquisition financing. If you want to do a bridge loan or not, you can do a bridge loan. You just put a little Y in there, yes or no for bridge loan. if you want to do a regular loan. And I'll explain that a little more in depth in a little bit. But you've got your interest rate if you want to do interest only. I've got a function that allows you to do a refinance, which I think a lot of other analyzers might not have. And you can put in here what year you want to refinance. It'll base the value for the refi off of your selected cap rate and the NOI at the year that you choose to refinance. And then, it might return some capital to you, or even profits on top of it, or just pay off the old loan, really however you structure that. And then down here, you can input when you want to sell the property. And really the goal is that kind of wraps up the financial projections, right? I'm going to buy it for this. I'm going to earn X amount of cash flow along the way, and I'm going to sell it for this. And there's my profits calculated at the end. And so these boxes kind of just calculate what your end profits are. So that all flows, guys. All the information flows to this last page. To keep it simple, this section just summarizes this pro forma tab. It just takes out all the detail and compiles it into this brief analysis so you can look at it. And then they've got a section here for investor returns. So if you're buying it on your own, this is the section you would look at, and you would kind of change all these splits to 100% just to yourself if you're buying it on your own. If you are doing preferred returns and different income splits or hurdles, this is where you look at the investor returns. And this is where I focus most of my attention on, because the way I find the purchase price is by, hitting certain metrics on returns for our investors. If I don't have, for example, a 7-8% cash on cash and a 15% internal rate of return, I know I'm not going to have an easy time raising money. And we personally like getting higher returns to our investors in that. So, this is where I look at after we input everything, and I basically just play around with the purchase price until the returns get to where I need them to be.
Question about the purchase price, because we have a question here. After underwriting and finding the purchase price that works for your business plan, how close should it be from the listed price or the whisper price to actually send the LOI to negotiate? I'm going to answer real quick, and then I'll let you answer that one. But I really think Nicholas, it depends on your buying criteria, and it doesn't really matter what the original asking price is, what the whisper price is, especially if this is an off-market property that's not listed. But I'll let David get into that a little more, maybe.
Yeah, at the end of the day, the numbers are the numbers are the numbers, and the numbers don't lie. You guys will probably hear that from me. You'll hear that from a lot of people. I don't care if they're asking $20 million. If I need to be at $13 million to make it work, I'm going to offer $13 million. I'll probably start at 12.5, to be honest, to leave myself some negotiation room. So it really doesn't matter where they are at. What matters is where you're at. And if you want to find out, is it worth making an offer, you can always email the broker and just say, hey, I know you're at $1.5 million, but I'm at $925. I don't really want to insult the seller, but I'd like to make an offer. Am I even going to make the cut? You might say, I already have 4 offers at 1.4 and it's not worth your time. I have that happen to me all the time. Mm-hmm. And I'm just like, okay, well, I'll move on to the next one. And a lot of times I'll still send an offer and they're obligated to present to the seller. So just to get your name in front of them. But yeah, to quickly answer, it doesn't matter how far away. I'm normally within on market properties. I'm normally consistently coming like 15% under what they're asking. So,
gotcha. Hey, Dave, a couple quick ones. Hendra just put a question in. Does your calculator allow for waterfall splits in the does that allow for it in your analyzer?
Yeah, it does. It just has one level of waterfall. So it has like a preferred return hurdle, and then whatever the split is over that. And then it also has a split if you refinance and return 100% of investor capital, you could have a different split after that. So sometimes we do deals where we return 100% of investor capital. It goes from an 80-20 to a 60-40 or something like that. So, but it doesn't have like 8% and then a hurdle over 12 and then a hurdle over 15. We just don't get that complex, and most people really don't. But
yeah, and if anyone wants to know what a waterfall is, if you're not sure, just Google it. Waterfall multifamily. You'll find out. There's too much to get into probably for this call at this point. But the other question, there's 2 of them around renovations. One is, and I think you can answer them in the same way. How do you split cost of renovations between several years? And the other question was, how do you decide how many units to renovate? I guess upfront or Or yeah, and
Sure.
how do you know how many units to renovate? Usually half of them, so it's an easier sell. That's a question mark. And when? So I think both questions are kind of the same. Like, how do you kind of decide on renovations? How many you do, and how frequently, and over what period of time?
Yeah, I can get, I mean, if you want me to get more in depth, do we want to maybe hit those when I'm going through this section? But briefly, I mean, there's a couple of tools that I have in here in terms of how many units you're going to renovate at, during the course of the ownership of the property. I have a couple simple ways I use to play that out. And then how many units to renovate, really is just kind of playing around with the numbers and seeing what they look like. You could throw in, and what can the market support? Not every property, I wouldn't feel comfortable going in and renovating 100% of the units, because maybe the market you can't support 100% of those units being renovated and at the higher rent. So
Got it.
Normally our business plan is going to do 50% of the units, and that leaves some meat on the bone for the next buyer. If we're doing longer term holds, a lot of time we renovate 100% of the units. So it just depends. So that's kind of the gist of the analyzer. Guys, keep feeling free to ask questions along the way. And I will, Jamie will call it out, or I'll see it, and we can get your question answered. So I'm just going to jump in and show you what my process is. The reason I have this filled out from the start is because when I'm actually going in and underwriting a deal, and now I have an acquisitions guy that actually does them all for us on the front end, he loads up and puts everything into the analyzer. But when I'm doing that, it's definitely very concentration intensive and hard to do on a Zoom call. I tried to do it before and it didn't go so well. So I start with a filled out analyzer. I'm just going to walk you through how I fill it out.
Makes sense.
And so now type everything in. So first thing that I do, guys, I'll start on this inputs page. Like I told you, I normally start in this section. I want to complete this section up here and this part right here, because I want to get the T12 column filled out in here. I have found that banks and lenders love this spreadsheet. They love the way it's laid out. I frequently have lenders, brokers, and bankers say like, "Hey, dude, like I like your spreadsheet. It makes it easy for me to know what's going on. So thank you." So I think part of the reason of that is I fill it out and have this T12 info so they can kind of compare it to our plan going forward. And this is just also really helpful for me. Looking at it, I can see what did they do in the past 12 months? What am I going to do in the next 12 months? So to do that, you start in this section right here, current historical financials, and it tells you over to the left, what document are you going to get these from? So we've got the T12 and we've got the rent roll, as I explained before. Those are the two documents. So first thing is gross potential rent. If we go over to our T12, you guys will see that most T12s will have a line item for potential rental income. And then there's actually two styles that this is done. It's either done in this way, where it's an accrual basis in accounting, or it's done in a cash basis. So the accrual basis will show a top line potential income, which essentially is if all units were at market rental rates, what would you collect if you were 100% occupied? And then below that, it'll take out vacancy loss. It'll take out loss to lease, which is loss to lease is the difference between market rent and what you actually rent it for. It'll take out bad debt, which is rent that you have not collected and that you're going to write off. And it'll also take out concessions, which are one-time incentives like $500 off your first month rent. Well, that'll be shown as a negative on here normally. So that's the accrual method. The cash method is where they'll literally just show this net number, like net rent collected. They won't have the high end number and then the negatives below it. They'll just say like 64,376 net rent collected. That's the cash method. So, either way, you can still fill this out the same. You just throw that net rental amount into here, and then these will all be blank, these four items. So in this scenario, 842,100 is our gross potential income. We take that number, we pop it right in here. Same thing, utility reimbursement income. I'm going to look on the T12, and we're going to look for utility reimbursement. It's commonly called RUBS, which is ratio utility billing system. I mean, there's a couple different ways people say it. Resident utility billing system. Essentially, RUBS is a way where, if, for example, you have water sewer costs on the property, the bills are not, or the units do not have that individually metered. So maybe they send one water sewer bill per property or per building. What we do is we use RUBS, which is basically a ratio that we bill back to the tenants to get reimbursed for that, because the cost to separately meter it just isn't worth it. We might as well just say, hey, our bill for the month was 10,000. We have 100 units, so we're going to charge all the tenants $100, you know, to recoup it, or however it comes out. So that's RUBS. Basically, we're going to take this number 16,739 and we're going to throw it right in here. 16,739. Boom. Other income, really, that's going to be the rest of the remaining other income here. So we've got carport, pet fees, court fee reimbursement. We've got late fees, laundry income, all that other stuff we're going to add up here, guys. And that comes out to a total of $29,102.61. 29,102. So we've got that. Next, we're going to show our loss to lease and vacancy loss. So we've got our loss to lease, 20,043 approximately. We've got that there already. And then we're going to show our vacancy loss, which I believe we have 5265. That should match here, 5265. Concessions, I believe we do have one item here for concessions, 1,100. So we add that in. So essentially, we want our pro forma to just match this number. Hopefully it does. Sometimes for whatever reason it doesn't, but I think we're pretty close. 816,533. As you can see, all the numbers that we input in these blue cells, they just flow right over to here. I mean, it's all very simple. Excel is pretty intuitive. If I take this out, you know, it's blank here. This cell just has an equation that says equals this. So whatever I put in here in that blue cell, it shows right up there. So all this flows right over, and you just want to make sure this number matches your total bottom line gross operating income. So it does. That's good. Next is the expenses. We're going to do the exact same thing, but we're going to head up to this section. And we're going to put our T12 expenses in. So this is kind of step 2 here. So we're going to go through line by line and just fill out. I have these set of categories here, and then a couple of options for you to add in custom categories. These are the most common categories that you will see across all apartments of all time ever. I mean, these are just the most common ones. That's why I put them here. I have certain ways of kind of, you know, combining or joining them together. There are different labels that you might see. You know, you might see janitorial and maintenance instead of repairs and maintenance, right? Same thing. You might see contracted services versus contract services. I mean, you know, there's different names for these things sometimes, but you just want to group them as close as you can according to those labels. And the reason why I kind of standardized these categories for us is because I pay heavy attention to a really important metric around that, and that is the expense, the annual expense per unit, the annual expense per unit. And so what that allows me to do is, after, you know, I analyzed so many of these deals, I started realizing, like, hey, repairs and maintenance on a well-operated deal seems to range from, you know, $350 to $500 a unit pretty consistently. So I know if I go in and buy a property, I don't even need a seller's prior financials. As long as I go in there and take care of the property and clean it up, get rid of deferred maintenance, my ongoing maintenance expenses should probably be in that, you know, $400 to $500 a unit per year range. And so when I told you guys I bought this property with no seller financials, I did not have a T12. Was I scared to buy it with no financials? Maybe a little bit, but not that scared, because I knew that I could follow the basic rules and market standards for these different categories of expenses. And that if I operate it like most other people operate their properties, I should probably have a pretty consistent similar expenses. So I track that and I look at that over here. Sometimes I'll go into a property and water sewer. I'll input water sewer, and let's say it was 85,000 or something like that, and I see 885 a unit. Now that's a lot higher than what I normally see. I normally see 5 to 600 or 5 to 700. So this starts to tell a story to me. Maybe it's 885 a unit because there's a lot of leaks at the property, or there's a lot of really old toilets that are very inefficient, or there's a break in the sprinkler system or the irrigation system that's constantly running. And so by following these trends, you're going to start to realize, hey, this is off, or this seems right, or this is a well-managed property, or this is a terribly managed property. And so the more you follow these trends, the more you're going to be able to go in and say, maybe I could add value there. Maybe this is $900 a unit, but I could go in, spend $400 a unit on new toilets, aerators, low flow faucets and sinks, and fix any leaks. And maybe I spend $400 a unit times 96, 38.4, and then I could get this from 85 down to 60,000, right? I'm saving 25 grand a year, and I just spent 38.4. That's value add. I just a 65% return on my money by going in and reducing my water costs and overhead. And by the way, if that's something that you pass through to tenants, this water reimbursement before, and maybe that's something you reimburse. Now it's at 60,000. The tenants are paying less. I can up their rents by the 10, 15 bucks a month they might have been saving. So value add is most easily found if you follow trends and you see these common metrics. So one of the most important metrics, guys, if I'm going to list a couple different metrics off as we go through this. This is one of the most important ones. I very typically see total expenses range from $4,500 a unit to $5,500 a unit on most properties. So if you're at $7,000 a unit, you are probably really high. And if you're at $3,500 a unit, you're either in a state like Nevada where they have really low property taxes, or they're just under managing it and they're not spending enough, and you can anticipate that yours will be higher. So follow the trends. That's all I'd say. But really, we're going to go down, and I'm not going to go through every single one, guys, but you're going to go in and contract services. That's a very common category to find on a T12. We're going to just take the total, 33,415. And we're going to put that right here. General administrative is something I kind of throw a lot of general stuff into. A lot of times there is a category for general administrative, but I'll throw like bank fees, other little miscellaneous things that might be outside of a major category. I'll just throw in G&A. That might be like employee uniforms and paper and supplies for the printer, for the leasing office, stuff like that. So utilities, I'll separate out. You've got electric, gas, garbage, recycling, water, and sewer. We have a category for each of those: electricity, gas, trash, water, sewer. So all of those will separate out. Turnover is what you'll see a lot of times. Paint and carpet in a category on here. Outside of the repairs and maintenance category, you might see a turnover category, or you might see painting, carpet, appliances, that kind of stuff. I throw right into this turnover category. One thing I do want to highlight that is very different, actually two things. Well, one thing that changes significantly based on your property size is the payroll costs of the property. So when you get to a point where the property is large enough to support staff, on-site staff, you're going to have actual salaries and employees that are hired by that specific property or the management company, but paid for by the property. And you're going to have a payroll line item. And so I very typically see this, as every 100 units, you're going to have one manager / leasing agent and one maintenance person at a minimum. So 200 units, you might have a manager, a leasing agent, a lead maintenance, and a maintenance support, and then maybe a part-time maintenance person. So every 100 units, that's kind of what we see is one-on-one manager / leasing and a maintenance person. So it comes out to about $1,000 to $1,200 a unit, and really this depends on where you're at as well. Some cities wages are higher. If you're in California, or if you're in, downtown Dallas, or if you're in New York City, or, you're in a place where the wages are higher and labor is more competitive, you're going to be more, closer to $1,200-1,300 a unit. So,
Hey,
easy question. Is it? Oh yeah.
Yeah, there's a few questions that are popping in, and
Sure.
I'll squeeze these guys in. Guys, see, Mar has a question, Nick, all these different people. Well, one question I had is there, like, in the blue here, the 4 boxes that you have below, to your point, these are kind of like the general expenses, but do you have a most common expense that's not amongst these common expenses that you see pop up on T12s when you're analyzing deals?
Something outside of these categories, you're saying?
Yeah. Something you add on with some frequency.
Not really. No. I almost never use these. I mean, I try not to, because I like to group everything into here so that I can, follow these trends. But I very rarely, at least in the properties I see, which are normally professionally managed, I normally see these. These are the categories that we'll be working with. The one thing I do see a lot of times is security. Actually, I mean, I don't look at a lot of D properties, C- properties, but if I happen to, you might see a line item for security, patrol or something like that, which is a larger line item that sometimes I'll separate out.
Okay.
So I would say that would probably be one.
There's a couple questions about expenses and either shopping them or managing them. So do you have somebody other than the manager, I guess? Is it worth hiring anybody else, or shopping expenses, anything like that? Any expense control tips that you might have for folks?
Yeah, at first I would say definitely, run it by a property management company. They'll help you. Just ask them to. You can send them your underwriting, or say, hey, could you work up a budget for me for this property I'm looking at? I mean, don't do that to waste their time, but if you're building a relationship with them and you intend to use them as your manager, management companies will probably provide a lot of services like that, So definitely I would say that. And even, once you look at so many of these, you could give me literally right now a 300 unit property I've never seen before, and I can go down within, probably 2 minutes and hit every single one of these numbers pretty accurately, just off the top of my head, because I look at so many of these. And I think that's like, once you do a ton of these, you get to a point where it's pretty easy to do that. But at first, definitely shop at a management company.
All right. And then one question I'll pop in here just to kind of keep them rolling is about somebody's got a 6-unit, Aaron has a 6-unit property he's looking to buy, wondering if it's a good idea for him as a first-time investor to do that, which I think we answered, like, if the deal's good, the deal's good. But he mentions in here that he analyzed it with a bigger pockets calculator. I haven't used bigger pockets for multifamily, but compared to your calculator, have you looked and compared any advice on using a calculator like this versus a bigger pockets calculator?
I've never used a bigger pockets one, so I couldn't. Yeah, I couldn't tell you.
Yeah,
I don't think it's as comprehensive from what I've heard.
Yeah, I don't think it is. I think that's something, and other folks can respond on that if they'd like, but I don't think there's a good bigger pockets calculator. Thanks. Tal says no comparison.
Tal says no comparison. What's up, Tal? How you doing, buddy?
I don't think there's one. Yeah, it doesn't work very well from Nicholas. Yeah, I don't think using a bigger pockets calculator is gonna get you what you need to know if this is a good deal or not. So I just wanted to get that out there while we were talking about it. So
yeah, and there are a lot of other people that, I know a couple other people that sell analyzers, and there's other ones out there. I mean, I think what has attracted people to this, and a lot of people have switched from other ones to this, is it's complex, but at the same time, it's simple. If you look at other ones, it's definitely simpler. It's easier laid out, and it has everything you need and nothing you don't need. A lot of times there's too much, and I wanted to keep it simple. So.
Josh Dorgan's going to kill me. Yeah, well, he's not the CEO anymore. So.
That's funny.
I think we got a couple in there. There's probably a few more guys. We'll get to as many of these as we can, but I'll let you keep rolling, David.
Cool. So I'll keep moving. I mean, one thing I really want to point out is the taxes. Do not assume because their taxes were $133,000 last year that they're going to just go up 3%. Most states, every time a property is traded, bought and sold, the taxes will get reassessed. And so what that means is they're going to take your new purchase price. They're going to up the assessed value based on that, and then take the current tax rate. There's a lot of different ways to do this. I think I have a video on my YouTube that breaks down literally all the different ways that taxes can be calculated. And so it's more in depth. Check that out. I can't get into it here, but one of the most important things is knowing what happens with taxes. Really, really do your research on that.
Okay.
So, yeah. One thing you can do with taxes actually is you can call the local tax assessor's office. Don't tell them what property you're buying. You don't want them to know what property you're buying, but ask, how do they calculate, what happens if you do buy? Say, hey, I'm interested in buying property in this area. What happens if I do buy an apartment complex? Are you guys going to reassess next year? My taxes jump way up. How is that calculated? Is it based on the new purchase price or whatever? So, but don't tell them what property you're buying, because then they're going to start tracking it, and then they're going to nail you for sure. So definitely look into that. And insurance, I nowadays, I almost always get a rough quote on insurance from my provider before I even put a final offer in. If I'm going to put a strong offer, you can ballpark it per unit for sure. We buy a lot in Texas, and Texas insurance has really drastically changed in the last 12 months. So that's why I do it. But a lot of places it's consistent. You can just ballpark it. So.
Okay.
So I'll keep moving on, guys. Really, a lot of this is pretty self-explanatory. You take from the rent roll how many 1 bedrooms, how many 2 bedrooms, what's the square footage, what's the unit count. You throw that in here. Down here, we throw in what's the current monthly rent on average that they're getting for each unit type. I do that so I can compare to the new market rent for standard units versus renovated. And then you're going to want to go do some research on this next part. Really, you could do a pretty rudimentary search on, I'll do this really quick, on apartments.com. And so I think I'll even show you good old West Oaks here. This is the property where I see you guys can put your eyes on it. This is actually the property we bought. And wow, they're asking $950 for this. So when I bought this, this is the literal rent roll that we have. So for the 801 square foot 1 bedrooms, they had 655. I think some of them were even lower, 635. So they're now asking $950, which is par for the course, because I got those units on average up to about $850, some up to $900. And then the 2 bedrooms I took from $750 up to $1,200 on some of the 2 bedrooms even. So these rents are awesome. Good for them. So apartments.com, what I do, keep in mind all the rents on here are asking rents. They're not actuals. But for the most part, people aren't putting asking rents way above what they're actually getting. They're normally pretty in line, within 5 to 10% of what they're actually getting. So I'll look at comps around that are similar in age and in amenities. So I'm not going to compare a 2012 built facility, Class A area with, a pool, a fitness center, to a 20-unit complex with flat roofs that was built in the 70s. I mean, it's just not a comparable. You're going to have a tenant walk into both, and it doesn't matter if they're the same rent. They're obviously going to take the nicer, newer one. So you have to make sure you're comping to the correct properties. And so one thing I do look for is age. I mean, normally look for something within 10 years before or after yours was built, and then look for something with similar amenities, similar location. So, West Oaks is right here. This property called Keswick right next door. I'd look at this and I'd say, you can maybe call them and say, hey, are they renovated? Are they what you're showing in your pictures? Because this is, to me, a pretty dated look. I mean, this is really old dishwasher, old cabinets. I mean, nothing fancy about this at all. Old vanity, old fixtures. So I would ask them, is this $880 or is this nice? What is this price get me? Is this renovated, non-renovated? And just look around at a bunch of properties. And so once you start to see a trend, if our units are at $655 for the 1 bedrooms and you see these guys getting $880 and you see 3 or 4 properties that are like that, I mean, it's pretty easy to tell at that point that your rents are below market. So, at that point, I would go into the analyzer and I'd say, okay, I feel like maybe I could conservatively get up to $850 for my 1 bedrooms. And then keep looking around. You might find some renovated comps where they're getting maybe up to $950, for example. So, you basically, there's no perfect way to do this. You overanalyze it, you're never going to buy a deal. You can't overanalyze it. Look at the comps. if they're higher than yours, take the average of the three you're looking at and use your own intuition and say, okay, for this property and for what it looks like and where it's located, I think I can get this much compared to the competition. So,
David, what do you think of Rentometer or Rentometer? I don't know which way you say it. Rentdata.org, any of these other sites, do you leverage them, or are you pretty much looking at comps, apartments.com, Zillow, that kind of stuff?
I have used those. It's been a long time, so I don't know. I can't really speak to the accuracy of them. We have a software called CoStar, which I'm sure a lot of people are familiar with here. It's stupid expensive. I don't even like how much we pay for it, and it's gone up since we've subscribed. We pay $1,200 a month for one user for national access to this software, which is fantastic. They own apartments.com. They own LoopNet. You guys probably heard of those. So great data, but it's super expensive. There is, forgive me if I can't remember what it's called. There's a competitor to CoStar and Yardi Matrix. It's much cheaper. Their logo is purple. I can't remember what it's called. Somebody probably drop it in the comments. I think it starts with an R as well. But Reinomy. There we go. Thanks, Bobby.
Okay.
Yeah.
Is
so
that a competitor? Okay. Yeah. Gotcha.
It's kind of a competitor. When I saw data from it about a year and a half ago, it was really junk data. But they've got huge investments in that company since, I believe, and they've been. I think they were acquired by somebody else. I don't know, but yeah, I think they're probably getting better.
I didn't love it, but it's been a while. So I think we both tried it. But
CoStar is very accurate, though.
Sure.
Yardi Matrix very accurate, but very expensive. So that's what I use for rent.
Okay. So this is how you're. Go ahead.
Yeah, I was going to say another thing is property management companies normally have access to Yardi, CoStar, or ALN. And these are all big data softwares that have these comps in them. So you can go to the property management company that you've built a relationship with and say, hey, can you pull me a rent survey for this property? And they'll do it, and they'll send it to you for free if you have that relationship. So leverage those relationships.
So real quick on something right now, somebody asked this question about what if you're unable, like in this time, to raise rents, or that's the assumption anyway, although we just raise rents on a property. So if you're, what is there anything you would do? So you comp out, you average the 3, all the stuff you talked about, but then you've got COVID hanging over your head. Do you do anything differently in your analysis, in your pro forma of rents now? Might you knock it down 10% or something like that? Or do you just say, hey, you know what? I don't know what it's going to be. I'm conservative anyway, so I'm going to go in with what I got and go from there.
Yeah, I'm kind of doing a mix with what we've got. If I really don't know the area, I'm going to err on the conservative side. If I'm buying in an area where I really do understand and know, I'm still assuming we can get rents up even with what's going on. I'm just probably gonna increase my loss to lease and concessions over the first year or two of the ownership, which we can do on this page, and I'll show you guys. And so that's kind of the throttle that I use to adjust for that.
Got it.
Yeah.
Got it. That makes sense.
Yeah. I mean, you do have to be realistic with what's going on. We're not going to see as many rent increases and as many, we're going to see higher bad debt probably, right, and all this. So definitely you got to take all that into account.
So another question on expenses that popped up. Seeing a lot of T12 showing 37 to 42% expenses. Properties are under 50 units. Is that typical, or does it cause you concern? I was under the impression a really well-run property should run between 43 and 45%.
Yeah. A well-run property is normally around 45 to 50% mark. I mean, most properties on average, especially large ones, are going to be around the 50% mark. Small properties I have seen pretty frequently that they run in that 35 to 45% mark. Smaller properties do. So it's not uncommon, especially if you have one in a nicer area with higher rents. It's not uncommon. So I wouldn't be too freaked out. Anything under 35% is not normal. So.
Yeah, I've also, I mean, my take on this, and you're playing in rents that are at a certain level, but people that are looking at property, I've seen it. You talk about Michigan, like Birch Run, Frankenmuth, that area where rents are like 500 pro forma, 550 pro forma.
Yeah, you're going to see really high expense ratios.
You should.
60%, and that's
correct.
Normal.
Correct, and you should, right? Because I've said this before: a 14 cubic fridge is $400 no matter where you buy it, right? So,
correct.
There's certain expenses that are fixed, but yeah, the more rent you get, the better the expense ratio you can get on it. So, yeah,
exactly. No, that's a great point, and that's something where you can see value add, right? If you're on a property with normal rents, $700-900, and the expenses are 70%, something's wrong, Those are
Right.
way too high. I would never, my investors would kill me if I was operating properties at those levels. So, but if you made a great point, yeah, if you have low rents, sometimes you will see properties with higher expense ratios.
All right, cool. So let's keep rolling because we're past the top of the hour. David was generous enough to stay on, but let's get to I'll let you keep going.
I'll keep wrapping up. Yeah, this is pretty self-explanatory. Closing costs here. One question I wanted to touch on. You guys asked, how do you deal with, say we renovate half the units or all the units? How do I count for, you're not going to have it all done from the start. You're going to be achieving those rents over time. And there's so many ways you could do it. I mean, you could literally drill down into a rent roll and say, I'm going to renovate this unit this month and this next month. You're never going to be perfectly accurate on that. So I found people ask me that, and I'm like, dude, you're wasting your time if you're actually going unit by unit. So what I do is I just play with this loss to lease. And I throttle it. Loss to lease is the difference between the potential and what you're actually getting. So if I'm going in and I'm going to have this new high potential rent, because this is based on, jumps up because this is based on my new market rents that I'm setting, and I'm renovating units, so this is higher. So I'm just going to increase this loss to lease and have it stabilized maybe by year 3 when I project that I'm going to have these renovations done. So I'll look at what they collected in the last 12 months. If I was at a normal loss to lease level, I mean, you look at this like this is way too high of a jump. You're never going to jump 20% plus in from this last year to this year. I mean, it's very uncommon. So I'm just going to look at this and say, hey, what seems like a reasonable jump with renovations going on, maybe a little higher vacancy, what seems normal. So maybe I'm 15, 16% loss to lease in year 1, maybe I'm 10% in year 2, and then maybe by year 3, I've done those renovations, our rents have stabilized, and we're at a normal, 11, 12% total economic vacancy. So that's how I do it. Real simple way. I mean, you're never going to be fully perfectly accurate. So that's just the quickest way I've found to do it.
Got it. Okay.
Yeah.
As far as taking this now, so let me ask you, I think you referenced it earlier, but I'll double check with you. The returns that you like to project out for investors, and what splits? Do you go 80-20? Is that the split that you operate at typically, or?
Yeah, so a lot of people do preferred return. We do a straight split with investors. It's an 80-20 split. 80% of the cash flow goes to investors, 20% comes to us, their sweat equity. We used to do preferred returns. However, we just decided that let's give a little bit more of the split to investors, and that allows us to earn more cash flow along the way. So Everyone's is different. Really, at the end of the day, it comes out to the same kind of metrics that we target in terms of annual returns. So
okay. And what are your what do you shoot for IRR? What do you shoot for all of these different metrics?
So we shoot for 8% cash on cash, which is shown right here, and a 15 IRR. 15. So really at this point, once the analyzer's filled out and we've got our renovations in, and you feel comfortable with these numbers, I start with the asking price and some general financing terms. Nowadays I'm gonna be a little more conservative, probably say 75% or 70% loan to value. And then, I'm going to go look at these returns and look at what they're at. And I basically just back the purchase price down until I hit my return. So, let's see what 4.8 does. Almost there, have a decent cash on cash, but the IRR is not really where I want to be. So, I might go to like 4.4. And so at this point, to me, these numbers look really strong. Probably too strong to the point where, my offer is going to be a little low. But really, I'm just going to start there and put an offer in and see where, I know my ceiling is probably 4.65 or something like that. This is probably a little higher than that, maybe 4.7, but I know that my ceiling is going to be here. So I'll start a little bit lower than that and then work my way up to the point where I hit these numbers.
Okay. Do you acquisition fees? Do you charge a standard acquisition fee, or does it depend on the deal?
Yeah, it depends on the deal and who our equity source is. Sometimes if we're using private equity versus, individual investors, it's different. But 2%, our standard structure is an 80-20 split. We do 2% acquisition fee on purchase price. We charge a construction management fee because we oversee construction. That's anywhere from 5 to 10% of the construction cost. Then we charge an asset management fee, normally 1.5 to 2% of the gross revenue.
Okay. Let's clip a couple off here that I have in the chat here. So what is the ROI you look for in your renovations to make it worth it? ROI you look
So
for.
renovation ROI, good question. I have a little thing over here where it shows what's the dollar spend compared to the increase in rent over the current rents. And so I'm normally looking for something higher than what that IRR target is, so 15%. Anything really higher than that, if I'm getting a 16 to 20% minimum, that's going to increase and improve the overall look of the deal. So ideally in the 20 to 30% range. But
Okay, cool. Just seeing if there's any other questions. Nicholas, what if someone came to you with another syndicator with a deal? So what criteria do you use to partner with somebody who maybe came to you with a deal, if any, or do you not partner with anybody?
yeah, well, to date, I haven't partnered with anyone, no co-GPs. I mean, everything I've done has always been on my own or with like my business partner. But yeah, we're open to it. If somebody brought us a deal, we look for 100 plus units. The markets we're in, Texas, major cities like Atlanta, Indianapolis, Columbus, Ohio, Metro Detroit, B areas, value add type product, garden style.
Makes sense. Makes sense. Yeah, I think we're all looking for that, but you're getting them. So
everyone's looking for it.
You're doing a great job with it. So lots of other questions here that we could get to. Questions about dictating who materials are purchased from. What is your criteria for investors? I think you touched on a lot of this stuff already. I'm just seeing if there's anything else that pops up here. You talked a bit about your acquisition strategy. Is there anything that you haven't talked about with your acquisition strategy at this point that you would be open and willing to share with these folks as far as steps you take or things you think about?
Yeah, so I mean, we look in a lot of different ways. Like I said, I mean, we send mailers direct to owners. I have a team of 10 people that actually cold call every week. I get them listed, and then they cold call direct owners to find off-market deals. And then we have a lot of broker relationships that we're constantly working. So, I've worked with a lot of people on helping them getting started in this, and obviously went through it myself. The biggest thing is just consistency. If you're consistently digging up deals over the course of 6, 8, 9, 12 months, I mean, you're going to find something at some point that makes sense. So,
if I could ask, what level of mailer or cold call? You have 10 people, so that's a pretty significant number. Like, what's the per day? How many deals are you trying to source? So that doesn't mean how many you're analyzing, but between cold calls and mailers and talking to brokers and all that stuff, like how many deals a day or a week or a month do you think you're?
Yeah, I can give you our numbers for last year. We tracked those pretty closely. So keep in mind, we're conservative buyers, and a lot of last year we looked in really competitive markets like Dallas, Fort Worth, Austin, Houston. So I think we looked at like 450 deals total, meaning like if a deal hits my inbox and it's 100 plus units in the market I like that's a deal. We underwrote north of 200 deals, like ran it through the analyzer, made about 125 offers, and we bought 3 properties.
That's your funnel.
So, yeah, that's about the funnel.
That's the funnel.
We make a lot of calls. I mean, we make about 500 calls a week. When we're in acquisitions mode, we're making about 500 calls a week and 500 mailers a week out to owners.
Beautiful. Okay.
Yeah.
A bunch of stuff in here, but it's hard to keep up with all of them.
There's a question about the team. What does your team look like? We know brokers and something said brokers and lenders probably going to be the same or might be. What does the rest of the team look like?
Yeah, so my internal team is myself, my business partner, and then we have a full-time partner that does asset management, and then we have an investor relations guy in the office. So it's just us 4. And then external, we have our real estate attorneys. We have our insurance providers. We have tax consultants that help us estimate taxes. We have lenders, multiple loan brokers, lender contacts, tons of investors, private equity partners for bigger deals that we need somebody to stroke a $7-8 million check. We're doing one right now where we're buying a deal cash for $10 million, and they're going to put up all the money cash. So they're one person writing 90% of that, and I'm coming up with the other 10%. So that's a partner.
Well, let me ask you. So you've got you said a investor relations person and you've got an asset manager. Is the bulk of your time in a day spent on the acquisition side, just analyzing deals, talking to brokers? Like what is your time or your partner's time spent doing?
Yeah, so what I like doing the most and what I think I'm the best at is that acquisition side. So I'm obviously I give final touch and say on like pricing and numbers. I have an acquisitions guy. I didn't mention him. He's part-time acquisitions. He underwrites all our deals, sends them to me, and then I get to tweak and review them because it does take a lot of time filling these out. So we're looking at so many deals. He does that. I spend a lot of time reviewing deals, negotiating with sellers or brokers, reaching out to brokers, looking at deals. And then when we're under contract, I spend a lot of time managing the transaction. So there's a ton that goes into managing, raising the capital, to managing the lender, the timelines with the seller, title, all that kind of stuff, third-party reports that we have to order, inspections. And then, the other guys on my team, asset manager and my other business partner, they're more on the operations side. So they'll work with a property management company, make sure the lease audit's done, our internal due diligence, quoting the renovation, renovations with the contractors. And so we kind of have a good mix of acquisitions versus operations, and then kind of bridge that gap.
Okay. We're about 5 minutes to the 90-minute mark, which, I want to be respectful of everybody's time, especially yours, David, with this. So let's, I know there's some questions we didn't get to, guys. My apologies for that. There were so many that came in. It was unbelievable. You're a very popular guest, my friend. So let's start to wrap this up. So there are a couple questions in there, trying to consolidate them about either getting into your first multifamily or even going from maybe the first small multifamily into something larger. Can you give, and if it's two different sets of tips, that's fine, but can you give a 1, 2, 3 tips sort of thing or things to kind of do if you're looking to, let's start with, if you're looking to get your first multifamily deal, what's the first couple things somebody should do starting tonight or tomorrow morning?
Yeah. If you want the absolute quickest way to go from 0 deals to your first multifamily deal, I'll tell you how long it took me. I started in October or November of 2016. By December 2016, within 2 months, I had that first, actually 2 12 units under contract, and then we closed those by March. So within 6 months of literally starting in multifamily, and I had done research and listened to podcasts before that and all that, obviously, but really honing in 6 months to our first close. What I would say, if you want to do the same thing and you want to be in that same position, is start smaller. That's the first thing. Do not go 100 plus units, because then you're competing with people like us who have teams and we're really there's a lot. It's a very competitive space once you get into bigger deals. Do something 20 to 50 units. My advice is do something that has over $1 million loan size. And the reason I say that is because you have significantly better financing options. Actually, right now, you almost have, with coronavirus, you almost have 0 financing options with under $1 million, because most local banks are out. They're not lending. And if they are, they're at 40 or 50%. So $1 million loan size, start smaller, and do something in your backyard. Maybe you self-manage it, because let's say on a 25 unit, you should be charging 8% management fee. I charged on my first deals, 12 units, I charged a 4% management fee. I did an 8 pref and an 80-20 split to investors. So it's very favorable to investors. I charged a low management fee. I self-managed it. They weren't amazing deals. I think we, at the end of the day, got, we ended up getting the 8% annual return and a 15 IRR, barely. But they were decent deals. And if something went wrong, I got in there myself and did the work. I know I was in there several times painting units myself, literally to save the property money. So if you're really worried about things going wrong, you could always self-manage. You have more control over the expenses, more control over the project, and charge a lower management fee. And get in there and do your first deal. It doesn't have to be a grand slam 40 IRR deal. Just do something that makes sense on paper. And if you're smart, you'll figure it out. You'll make it work.
Okay, 2 other quick questions. So if you got that 10 or 15 unit, you own that, maybe you bought another 10 unit, right? You got this nice little portfolio and you're like, I want a self-sustaining property where I can put a manager on site. I want 100 units. What's the 2-3 things that somebody needs to do to step up from that 15 unit to that 100 unit or 90 unit?
Yeah, connect with, if you're not going to self-manage, connect with management companies. Start talking to brokers that are trading those larger deals and start getting some input from them. And then really get your capital situation squared. I went into this 96 unit I showed you guys today. I only raised like a couple $100,000 before that, and then I had to go to raise $1.7 million. I was 21 with no track record. I still to this day don't even know how I did it.
Well, how? That's the second question I had. So is this friends and family, people close to you? Even the first deal, like how did you, like somebody asked about like how did you have enough credibility to raise capital, or how did you convince investors to raise capital?
I didn't have the credibility. It was literally my tenacity. I just wouldn't stop. I called people till I was blue in the face. And then really at the end of the day, it was me knowing the numbers that convinced a couple people to get on board and raise that first couple $100,000, saying like, hey, like this is a real plan, and most of them were local, like small business owners, or they fixed and flipped houses and they had $25,000 or $50,000 to invest. And so, I just showed them the plan and said, hey, the rents are here. I'm going to get them here. Here's the value now. I'm going to get the value here. And they believe me, but it was the numbers. If I didn't have that piece of it, they wouldn't have trusted me. So, and then going bigger, it was just doing that same thing times 100. I was just calling more people. I was knocking more doors. I was asking for more referrals. I was advertising more online, right? So all of the above. Yeah, it was a grind. That was the hardest thing to date I've ever had to do.
Yeah, like I said, that's what you had though. You had energy and time, so you leveraged both. So that's really, really cool.
Yep.
Ben, any final questions before we find out where to get
questions? I saw a couple questions asking about where can people find more about you. I think we talked about this in the beginning, but if you want to let people know where to find you, I saw some questions of people wanting to invest probably. Maybe with you. So talk about the deal analyzer, your website, and anything you want to mention at this point.
Yeah, I'll drop my email in here. Anyone that wants to get in touch with me, it's david@obsidiancapitalco.com. We always have investment opportunities. So if you're interested in that, hit me up. Deal analyzer is on my website. A lot of you guys know I'm very active on Facebook. You can find me, just search David Toupin. And then I'm probably most active on Instagram. That's the easiest way for you guys to hit me up. We've got a strong following there. So follow me. It's @RealEstateJedi. So hit me up on Instagram. And it's probably the quickest way to grab me.
That's amazing. That's amazing. So do you have tutorials for the analyzer? One last quick question. Is there any...
I do, yeah. Right on the website on that page, there's a video, and it's just it's just what I did today, but even more in depth. And I will literally walk you through step by step how to fill it out and everything.
Perfect. Everyone, thank you so much for joining us. Here's what I would ask of you. Again, I want to make sure that there's learning, that you guys are taking this stuff away. Jump on Instagram, jump on Facebook for @multifamily and more. Go into the Facebook group if you need to, in the Michigan group or the Florida group, whatever one you're part of. But even on the Facebook page, facebook.com/multifamilymore or Instagram @multifamilymore. Just drop a quick comment in there about what you got from tonight, what you learned, what you took away, the value you may or may not have realized you were going to get from tonight, by going in with David. Some things maybe you thought maybe you knew more about than you actually did. But I appreciate everybody jumping in tonight. It's amazing. A ton of information tonight. Probably gonna have to go back and watch again to get all of it. But David, thank you so much for jumping on tonight. Thanks for staying late. And
no problem, dude.
Yeah, this is great, man. I appreciate it so much, and we'll be in touch for sure.
Yeah, hopefully provided a lot of value, and everybody out there, just go and get some practice. I mean, it's not something you learn overnight or just from one video. So start finding deals and practicing.
Perfect. Ben, any last words?
Thank you, and good night.
Thanks, guys. Have a good one.
All right. We'll see everybody. Good night.
Bye, everyone.